Good morning, students. Now we are going to start Module 4, Lesson 3. Module 4, Lesson 3, Money Market. This is really a very big lesson. So I divided this lesson into two parts. In the part 1, we are going to discuss functions and structure of money market. Then in the second part, we are going to discuss instruments of money market. And in the third part, we are going to discuss limitations and reforms of Indian money market. So it is divided into three parts. It's really very important topic. Many times this question is asked that explain the function and structure of money market. Let us start the structure of money market in India. The money market is the market for lending and borrowing of short-term funds. Always remember, money market, short-term funds. This sentence can be asked for true or false. Money market is the market for lending and borrowing of short-term funds. It deals in funds and financial instruments having maturity period of 1 day to 1 year. So the period is very short. The role and functions of money markets are: 1. It provides a mechanism to achieve equilibrium between demand for and supply of short-term funds. 2. It helps RBI in effective implementation of monetary policy. 3. It provides a venue for investment of short-term funds with fair returns. 4. It provides funds to users to meet their short-term needs at fair prices. Now, what are the components of money market? Number 1, the institutions. In that, the government, the central bank of country, commercial banks, cooperative banks, other financial institutions, business corporates and primary dealers are the important institutions in the money market. Now, what are the instruments in the money market? Call money market, treasury bills, commercial bills, commercial papers, CPs, certificate of deposit, CDs, repos, money market mutual fund, MMFs, liquidity adjustment facility, LAF, and marginal standing facility, MSF. This we are going to discuss one by one. And the third part is market segment. We have call money market, treasury bills market, commercial bills market, CP market, and so on. Each market has its own specific market and instrument with specific norms applicable to them. Okay, the general structure of the Indian money market, it is divided into two parts: organized money market and unorganized money market. This question can be asked like explain organized money market or unorganized money market, or combined question, explain the structure of Indian money market. So both the things you have to give. In organized money market, there is Reserve Bank of India, scheduled commercial banks, lenders, development banks, investment institutions, regional rural banks, foreign banks, state finance corporation, etc., DFHI, etc. In unorganized, indigenous bankers, domestic money, then nidhis, chit funds, traders and friends, brokers and dealers, and then whatever types of markets are there, that is there. Now we will discuss one by one. Players of Indian money market. RBI. RBI plays the very important role in an intermediary and regulatory money market. Money market comes within the direct purview of RBI regulation. The objective of RBI operations, the objectives of RBI operations in money market is to ensure that liquidity and short-term interest rates are maintained at levels required for achieving the objective of monetary policy. The primary objective of monetary policy is to ensure economic growth and price stability. Second, government. The government needs to borrow funds when budgeted expenditure is larger than budget revenue. The budget deficit is made up by raising funds through the issue of securities in the money market. So the government is the active borrower in the money market. Next, banks. Banks undertake lending and borrowing of short-term funds. Next, financial institutions. These institutions also undertake lending and borrowing of short-term funds. They transact in large volumes, so they have significant impact on money market. Then next, business corporates. They transact in money market mostly to raise short-term funds for meeting their working capital requirements. Next, non-bank financial intermediaries. They consist of mutual funds, foreign institutional investors who accept deposit in various forms and lend or invest in different economic activities. Next, Discount and Finance House of India, DFHI. It works as a specialized money market intermediary for stimulating activity in money market instruments and developing secondary markets in those instruments. Next, primary dealers. They were introduced in 1995 by RBI to develop an active secondary market for government securities. These are the players in the Indian money market. Okay, now one thing is there that when we are talking about the players in the Indian money market, this is like these are all the organized sector. These are all organized. So in the previous slide I told about the organized sector. So in organized, whatever things are there that we are showing here, these are the players of organized sector and we are discussed their role. So when the question will be there that explain the players of organized sector and their role in the Indian money market, you have to give these 8 points. Okay, now we are going to discuss about unorganized sector of Indian money market. In unorganized sector, the first one is indigenous bankers. We can say that traditional bankers. They are financial intermediaries which operate as bank, receive deposit and give loans and deal in the hundis. The hundi is a short-term trading instrument. The rate of interest differs from one market to another and from one bank to another. Indigenous bankers are also known as Kathwals, Sarafs, Shroffs, Shetis, etc. They are popular because of their simple and flexible nature of operation, their informal approach and personal contact, prompt services and availability of timely funds. So many people prefer to go over there. Mostly they are into the rural areas. Next, money lenders. They predominate in villages. They are also found in urban areas. Interest rates are generally very high and large amount of loans are given for unproductive purposes. Unregulated non-banking financial intermediaries. Unregulated non-banking financial intermediaries. In that there are 3 types. Number 1, chit funds. They are saving institutions. The members make regular contribution to fund. It is more popular in Kerala, Tamil Nadu and Karnataka. The nidhis. They deal with members and act as a mutual benefit funds. The deposits from the members are the major source of fund and they make loans to members at reasonable rate of interest. They are highly localized and peculiarly to South India. Next, loan companies. They are also called finance companies. They offer high rate of interest along with other incentives to attract deposits. Loans are given at a very high rate of interest, generally 36% to 48% per annum. And the fourth unorganized sector of Indian money market is finance brokers. They are found in all major urban markets especially in cloth market, grain market, commodity market. They are middlemen between lenders and borrowers. So this is about the one question. Explain the structure of Indian money market. You have to give organized and unorganized. Here the players of organized sector, that all 8 points you have to give. Unorganized, all the 4 points you have to give. This is one full question. It can be for 7 marks or 8 marks. This is what you have to write under this. Thank you.